It's a sad day in the truth about real estate investing world for Canadians. A highly leveraged group of landlords with hard money loans, heavy renovation investment strategy in tertiary markets. This group of landlords is seeking bankruptcy protection. I've posted about this, I've been posting about this in my social media last week and a half or so. Um, it's sad. I've included links in the show notes from the Appointed Monitors website, where you can find all the court documents related to the bankruptcy protection hearings, the articles in both the CBC and the Globe and Mail. Uh, Fingers crossed that this all works out. But the articles from the Monitor uh, mentioned how over 30% of the portfolio is sitting empty. There's over 600 units, and over 200 units are sitting empty across over 400 properties. Maybe I'm a small-minded investor. Take note though, my ex-wife and her family were in trades, so we only ever renovated one property at a time, as none of us liked negative cash flow or vacancy. Um, we're just that cautious, as it's negative cash flow that kills companies and investments. So yeah, we weren't a fan of negative cash flow. This company is experiencing a liquidity crisis as they have no more cash to renovate. There's 200 units that are sitting empty, as this company only has $100,000 in the bank, even though they borrowed $144 million across first mortgages, second mortgages, and promissory notes, which means unsecured debt. It's also called, yeah, it's called promissory notes, and the promissory notes adds up to $54 million a month from that's included in that $144 million owed. I've spoken to a couple insiders as well, the folks who know the principals well or worked with them. Thank you to the fans of the show who've been sending me DMs as well. As folks know, I don't shy away from publicizing losses. But this is a fluid situation. I believe in innocence till proven guilty. There are many things I'd like to say, but I won't, because this is a little bit close to home. I know some of the principals, and I know people who've lost money, uh, and yeah, I don't like seeing anyone lose money. And of course, I do not have all the details. I'm not involved, and no one will have all the details until this all is shaken out. One thing is for certain though is that many lenders have lending criteria for things I would not lend to. For example, when I worked for a bank, they would not give mortgages to properties in small towns nor on houses on septic tanks. Fine, that's their criteria. Calvert Mortgages, Calvert Home Mortgage came on the show and they stated they do not lend to small towns, including and their threshold would be a population of 50,000 population. Uh, these landlords who are seeking creditor protection, uh, they have a large part of the market share in small market Northern Ontario. They make up so much of the market. So to quote the Globe and Mail article, uh, they own almost 200 units, 200 properties in small town Timmins, and to unwind that portfolio would take 49 months for a controlled liquidation to exit the Timmins portfolio, and 23 months in Sault Ste. Marie. Populations for those towns are about 42,000 and 73,000 respectively. Just as important to note is those cities have barely grown as well. I actually checked Stats Canada on Sault Ste. Marie. Sault Ste. Marie actually shrank in population between 2016 and 2021. These are hardly markets I would consider for investment. That's just me though. For those who follow me for a while, 17 listeners, you know I am incredibly risk adverse. Funny enough, I've been criticized for investing in small town Hamilton, Ontario, with an exploding population over 500,000. Uh, Plus, it's a suburb of Ontario. Timmins is a suburb of no one. The closest big city is Sudbury, Ontario, which is 294 kilometers away. I can't help but think of the book, if you haven't read it, that's called The Psychology of Money by Morgan Housel, and the history of greed causing highly successful people who try to go to a different level of richness only to lose everything. Everyone knows Bernie Madoff for his Ponzi scheme, but did you know he had a legitimate brokerage firm They were actually money makers and market makers, and he helped develop what is now the Nasdaq stock market. He also served as chairman of the board of directors for said Nasdaq stock market. Then greed got a hold of him, and he started his own investment advisory service, which was the Ponzi scheme, and the rest is history. Slow and steady, folks. Don't get too greedy. Someone once told me, uh, never mind. Be strategic and value focused like Warren Buffett. And speaking of Warren Buffett, I was reading about how the late Charlie Munger influenced Warren Buffett's investment philosophy toward preferring to buy a wonderful company at a fair price rather than a fair company at a wonderful price. The philosophy underscores the importance of investing in high quality companies with durable competitive advantages and strong future prospects, even if their stock price might not seem like a bargain at the time of purchase. This approach is aimed at ensuring long-term value creation and capital appreciation, aligning with the overall strategy of value investing, but with the focus on the intrinsic qualities of the business rather than just price metrics. Now, everyone knows, not everyone, but I just got back from Austin, Texas. And from my research, it tops many top 10 lists for top places to invest in the USA. I'm looking to invest in wonderful single family houses uh, in one of the top 10 places to invest in America, which is almost the opposite of investing in tertiary markets in Ontario that do not have population increase. So if you don't believe me, go Google Sault Ste. Marie population stats can. Literally, they shrank by 1.8% over the 5-year period of 2016 to 2021. This Saturday, I'll be sharing my findings from my visit to Austin, what properties I'm looking at, how I plan to grow my portfolio to cash flow $100,000 per year. And that's before taxes, and that's from rental income. Note this will take a couple of years to do. This is not a get rich quick strategy at all. I'll need around 20 properties to do so. And so on average, I need to cash flow about $5,000 per property. Note that these properties are in the $100,000 to $350,000 US dollar range, which is about the same cost as a basement suite conversion or a garden suite. So you decide which you think is a better investment. I cannot wait to show all real estate investing Canadians what I consider to be the best investment for most Canadians most of the time. 100% ownership and control maintained, 10 times easier to scale than anything in Canada. All the benefits of being a landlord with fully outsourced property management. Yeah. And I'll have the show notes, and I'll have the link to register in the show notes. So on today's show, I invited my good friend Christian Szpilfogel to discuss the sad truth about real estate investing in managing and recovering distressed assets, understanding the root causes, and having proactive strategies. We discussed the risks of private lending, the responsibilities of borrowers. Christian has the unique perspective of having worked in a heavily securities regulated environment of mergers and acquisitions when was the general manager working under one of Canada's richest Canadians, only to see what is so he was quite shocked to see the wild west that is retail real estate investing, where some investors just, thumb their nose at the securities commissions, openly violating securities laws in the way advertising and soliciting the public for capital, even offering guaranteed returns. The last time I heard the word guaranteed returns was from the owner of a now bankrupt investment company, and he's on the run from the cops. Christian, being what I consider one of the good guys in real estate, I thought he was ideal to text at 9:30 a.m. this morning to come on the show for 10:30 a.m. to talk about losing money. Christian is the owner of a Lippers Group, where he invests his and only his family's own money. He has no courses to sell, no coaching to sell. He's not accepting OPM other than the banks. He just wants to help people. That's why we get along so well. Christian is also the vice president of Oreo, Ottawa Real Estate Investing Organization, a nonprofit member-based educational organization group. Annual membership is only $127. I'm a member too. Yeah, that's annual, by the way. $127 for the year. I'm a member too, and the value is unmatched. You can go to oreo.org/membership, and you can even go take a test run for yourself. Go attend a meeting for free. See if you like it. And my experience, the vibe in the room is wonderful. I've included again. I've included some links to news sources in the show notes. So if you want more detail on the case, uh, have a look there. I actually, please allow me to geek out for a little bit. I actually uploaded all the court documents, the CBC and the Globe and Mail article, and another article that I can't mention, all into ChatGPT as well. So I actually built a bot to be an expert on this topic so that I may ask it questions and whatnot, and they actually help me produce the show. So, uh, so please take a chance to learn from history, else be doomed to repeat it. I've seen this all happen before back in 2008 during the financial crisis. Folks saw this happen before in the late 80s during the Toronto real estate price market collapse. And also, please watch out for confidence artists. Note that con artists is actually short for confidence artists. Uh, be wary of people that are overly confident. You'll notice I'm not confident at all in anything I say. That's why I always stutter and slur. But anyways, please keep your investments safe and enjoy the show. Hello, Christian. What's keeping you busy these days?
Erwin, I guess the thing that's keeping us all busy is keeping up with all of the use of inappropriate use of borrowed money. So
Yeah, and so we are speaking specifically today about the what is over 140 million in private mortgages on I don't know, 600 over 600 units, mostly in Northern Ontario that we're talking about.
yeah, well, that's certainly one, right? And a friend of
Yes,
mine,
it is a bigger trend. Yes, yeah.
yeah, so that's one. And there, a friend of mine just sent me another one for somebody in Kitchener Waterloo that
Hmm.
looks like it was a clear Ponzi scheme, right? And charges of fraud are involved in that one as well.
Hmm.
So, but there's a lot of this going on right
There's a lot
now.
of this going on. Like Greg Martel out in Vancouver, BC area, he's on the run apparently. $300
Yeah.
million is missing. This and then Epic Alliance, which I've covered pretty extensively on the show before previously.
Mm.
So
Yeah,
this is a widespread problem. Probably not. We're Canadian, so I tend to focus on Canadian news, but I'm sure they have issues in the States as well.
oh, absolutely. I mean, but one of the big differences in the States is that, the Securities and Exchange Commission, the SEC, actually has quite a lot of teeth, and
Mm,
they also have the ability to bring in the FBI when necessary as well. So, in my dealings with, and as you know, I used to do M&A stuff in large corporate before getting into real estate.
hmm.
And the diligence we always put around all securities related items was very significant.
Right,
We had a lot of lawyers involved, very high
right.
priced lawyers to deal with it. But
Because
my
you work for publicly traded companies, right?
correct,
Yeah,
yeah.
so that's
So
why the diligence was the securities requirement was just like at the highest level.
it really is, but it's also that in my experience, the SEC in the US is far more diligent
Hmm.
about these things. They do tests, right, and verify things. It's not just on public complaint, but even if there is a public complaint, there's a lot more diligence there, and they have the resources to do
Hmm.
it. In Canada, as you know, we have an overarching, securities regulation framework at the federal level, but really it's all at the provincial level. So in Ontario, we have the Ontario Securities Commission, the OSC. BC has the BCSC, et cetera, right? And the resources of each of these provincial entities is not nearly as high as I wish they were to really start to crack down on
Yeah.
what I think is hurting individuals. So.
Yes. Yes. And yeah, maybe that's not the best format is to have provincially level security enforcement. Maybe a national, but that's not well beyond the scope of this show. What I more
Yeah.
wanted to cover was more some general things that we're seeing because all the problems with these I don't know if it's the right term. I won't say abuse, but a lot of people are going to lose a lot of money, and
Yeah.
in my opinion, there's a lot of lessons that have not been learned throughout history.
Yeah.
Like for example, there was a very large condominium in Toronto that went belly up back in the financial crisis of like 2007 2008.
Hmm.
And the lesson I drew out of that was like they went under because they couldn't handle the amount of debt they had.
Mm.
And and also mentors of mine like Tom and Nick Karadza, they share regularly how their father, bought a house on a on assignment. Uh, if I don't know if you remember back in like the late '80s, like people were like when there were no show houses, it was usually you know a temporary structure where people would buy houses for pre-construction. And then the market was so hot that once someone had their signed documents to buy a brand new build, they'd walk out the door and there'd be people out there trying to buy that paper off them.
Oh yeah, yeah, absolutely on assignment. I assume that's why a lot of condo sales these days don't allow for assignment before you take possession.
There's lots of reasons for that. But again,
Yeah.
my point though is that there's been through history where, market got too hot, people got in too deep. Um,
Well, that's right. And I guess the reason I was referencing the securities commissions is, and the fact that we don't have enough enforcement within our provinces is really that it starts to push back on the requirement or the need for individual investors to really do their due diligence on whatever they're putting their money into. Because there is a little bit of a regulatory safety net, but even if they invoke it, your money's still gone.
mhm,
It's not like regulation can come in and say all it does is punish the bad people, but your money's still gone.
mhm,
Like if you invested in something into a Ponzi scheme, yeah, the Ponzi guy will probably go to jail, get some
mhm,
serious fines, etc.
mhm.
But your money's still gone.
Right.
It's
Which
so
is why I'd like to see these advertisers stopped right away. Like people who like break securities code violations in their promotion and marketing,
Mhm.
it should be stopped right away. Like
Yeah,
the old
100%.
saying, "An ounce of prevention is worth a pound of the cure."
That's exactly right. So, and we've certainly tried to get, as you know, with Oreo, and I mentioned
Mhm.
this before, we
Love
want to
Oreo. Yeah.
try and get, Oreo, the Ottawa Real Estate Investors Organization. We wanted to get someone from the Ontario Securities Commission because we take things like, capital raise very seriously in terms of the legal requirements. So we asked the OSC if they'd like to join us. And I'll still put the offer out there on the off chance that someone from the OSC is listening to this podcast, right? They might be one of your 17 listeners, Erwin.
Mhm. Maybe someone
But
knows somebody.
yeah, somebody knows somebody. We'd love to have them speak at Oreo. We've done some informal reach outs, and so far they just say that they're not interested.
Mhm. Not interested.
No, not interested, right? But it
Wow.
comes
You think
back
they say
to
we're interested, just we don't have the time for it right now. Like we're
yeah,
not interested.
yeah. No, it really just their replies came across as we're not interested, right? Although it may be resource constrained, it's hard to say. It's just the
Right,
way I read the emails.
right,
But it's exactly as you say, an ounce of prevention is worth a pound
right,
of cure.
right.
So we'd certainly like that.
Yeah, I'd love
Uh,
them on the show as well. And to provide context, for example, like the fire department, the prevention unit will gladly come and speak on like my platform, your platform,
yep.
because they focus heavily on it. They have departments that focus heavily on the education piece,
Yeah, absolutely they
right?
do, and it's well worth it. Some of the towns that I invest in have a formal fire prevention officer, and they literally have a list of buildings that they go through.
Hmm.
So we get a call every year. It's time for your annual check, especially in the multi-unit buildings.
Hmm.
They do them
Hmm.
annually, all of them,
Hmm.
right? And it was a badge of honor when during the pandemic I called them up and I said, okay, shall we do our annual inspection? And they said, well, because of the pandemic, we can't go and hit every building, so we have to do it as a short list,
Hmm.
and you're not on that short list,
Hmm.
right? And it was specifically, and they said it was because said we never have issues with your building. We're just focusing on the buildings we normally have issues.
Hmm. Hmm. And we're talking about like life safety stuff. So it's great that they do offer education, and they're in my
Yes.
experience they're generally completely open to folks booking an appointment, coming in,
It's a
meeting with them.
serious,
Yeah,
it's serious, right?
no different than securities laws, man. Protecting the
No,
public.
that's exactly right. It is a serious issue, and that's why I'd like the OSC to come back or actually come back and say that they'd love to speak. But I mean, as you know, we have a really big crowd, so it's actually quite useful.
Exactly. It's a great leverage point. Just like the show. They can talk to 17 listeners immediately. Get that word out there.
Well, we all know her when you have far more than 17 listeners. So, but,
So
um,
I don't want to get into the live story that's going right now. Not into detail because it is a live situation. We don't know how this is going to work out. I still believe in innocent until proven guilty, but I think there's still some
absolutely.
lessons that folks can draw out for this.
Yeah.
For example, before we were recording, I was mentioning how uh, in one of these cases, there's a large allocation of properties in a small town called Timmins, Ontario, with a population. My Google was like 42 said returned like 42,000 population. Versus I've had guests on this show, like Calvert Mortgages, for example, which most people are familiar with, and they've said it on record. We avoid small towns with under 50,000 population. But
Mhm.
here we have an organization that owns a significant portion of the market. And to
Yeah.
quote the Globe and Mail, based on the run rate of that city in terms of real estate transactions, how many houses sell, to quote the Globe and Mail, their number was it would take 70 months to unwind that portfolio.
Yeah.
Right.
Yeah.
And
So they're
that's just
over concentrated, obviously.
over
And
concentrated, and I think it serves it make we need to mention it is like the tenants in these situations are in such difficult situations,
yeah.
right? So and these communities are not happy at all. Like the mayors of some of these cities have already stepped up and said like this is terrible for the city, terrible for tenants,
Yeah.
and this is a terrible look for all of us investors.
It sure is. It's just that no good comes from this, right? Other than maybe the lessons learned.
Yes, like
Um,
we all share some of this collective pain. Like I personally don't have know anyone personally involved in any of this, anyone who's lent to them. Um, but
mm,
still, I'm sad for the community.
yeah. Yeah, no, absolutely. But I think we need to get to the lessons learned on something like this as
Hmm.
well.
Hmm.
And I kind of look at it from the aspect of the lender and the borrower,
Hmm.
right? And there's proper underwriting principles we need to talk about from a lender's perspective, and there's the accountability as a borrower.
Hmm.
So, as you know, I run a very ethical practice, and I try to make sure that others that I can influence run an ethical way of doing things. And our responsibility as a borrower is paramount, right? I mean, first thing obviously is reputational damage, right? Especially in this online world that we have, you
Hmm.
can't really hide very well.
Oh no, people are after the stuff I'm seeing on social media, people's dirty laundry being aired. It's not good.
No, it's not, right? But as borrowers, we have to be very responsible with the money that we get. We have to have a clear understanding of how we're going to repay any money that's borrowed. We have to ensure that, like, certainly anytime I borrow money, right, it's not just that I have an intent to pay it back. I have a plan on how I'm going
Hmm.
to pay it
Hmm.
back, right? And I tend to
And,
run a very conservative operation. So
right.
the last thing I want is to be not just because of my reputational damage, but I personally, and I know not everybody's like this, but
Hmm.
personally, I don't want to be in a situation where I have to tell somebody I can't pay them back,
Hmm.
right?
Hmm.
I can't, I don't like it for myself. I don't like it for the lender, even if there is and we'll get to the lender in a second, right? But even if the lender has assumed a certain level of risk associated with the interest rate, right? I still don't want to be in a position where they're out of money because of me,
Hmm.
right? So as borrowers, it's a hell of a lot more than just a promise or a desire or an intention to pay back. It is very much about having clear plans, right? From the moment you take this debt on to the moment you give it back, that
Hmm.
you have a solid plan, not a hope and a prayer,
Hmm.
right? So,
Let's dig into what solid plan means. For
mhm.
example, like I was having a conversation with a client. So actually, no, sorry, I do know someone who has invested with one of these parties where I don't know what level. In terms, I'm sorry, I don't know if they're first, second, or promissory note position. Uh, but I made the suggestion to her like, are you getting ready to take over the property? And then her response was, "Take over the property? What do you mean?" So myself, if I would, I'd personally, as I've said it many times on the show, I'm not smart enough. I'm not. It doesn't. It's not within my risk appetite to be a private lender
Hmm.
because I know Plan B is I have to take over the property at some level. So
Yep.
if you're a promissory note investor, for example, which I would never be, that means I have to make the first mortgage and the second mortgage true and take over the property. So I'm driving up to Timmins or Sudbury and dealing with the conversion process, whatever it is, right?
Yeah.
Either exiting or finishing the reno, whatever it is, and
Yeah.
that is beyond my appetite for both risk and effort.
Yeah. Or even worse, like if you have an opportunity to be able to take over, right, that might be the better plan than going to a power sale or a foreclosure,
Yes,
especially in a market like right now,
yes,
right, where you may not be able to get the best return out of it because if it's been devalued,
hmm
the first mortgager may be kept whole, but the second mortgager and certainly the unsecured prom notes
hmm
are probably going to be in a world of hurt right after all the admin fees, the reduction in price to sell it off, etc. So
hmm
yeah, I mean, there's a lot of exits, right? But if people are just relying on power sale or foreclosures as a way to recover the money that they've loaned out on a property,
hmm
um, that's not necessarily the best exit. So what you're saying is spot on, which is that aside from foreclosure and power sale, you might have to seriously consider taking over the property.
Right. And then people need to understand that. That means if I'm in promissory note position, I have to pay the first mortgage and pay the second mortgage as well.
That's
So
right.
when I went into an investment for positive cash flow reasons, I now have significant money going out the door.
Yeah. Yeah.
And in the news, I think it was Globe Mail, both CBC and Globe Mail also mentioned that there's over 200 of these properties or units are vacant. So there is no rental income coming in for over 30% of the portfolio.
Yeah.
Right. So this is so if unfortunately if your private lend position is on one of these vacant properties, there's no money coming in.
Yeah.
Right. And that's formula for a failing business.
It is. And fortunately for them is we have laws associated with creditor protection, right? And the ability to restructure things. So in the States, it's referred to as a Chapter 11 types of, and people are probably more familiar with it in that context. But it gives you a chance to get your house in order to see if there's a way to resolve things properly rather than
Mhm.
it become a wild west with all the different lenders.
Yeah.
So at least they've got that piece of it, and hopefully they can restructure their way out of it. Doesn't look good, to be perfectly honest,
Mhm.
but that's a mechanism that's sitting there and that works. But you were talking about as a borrower, right? What kinds
Oh
of
boy, yeah.
processes we need to put in place, and I think that's really worth discussing before we get to the lender side. So as a borrower, I'll give you my view of it and what we do is that, one, we have a solid plan for execution.
Mhm.
So it's not I see some people say, oh, I'm going to do a flip. This is my entry price. This is my ARV. This is the discount I need. And then I just execute. Well, execute on what? So you need a plan that takes you right to the finish line in terms of being able to execute. So that's thing one. The second piece is you need a risk management plan. So if you are planning to do a project, I don't know about you, Erwin, but personally, I've never had a project go exactly to plan.
Never happens. Always
Yeah.
over budget, over time.
Yeah. And with real estate, there's a lot of moving parts.
Yeah.
It's, that things just go wrong, like things you just can't explain, right?
Mhm.
Sometimes, like cost of goods goes up, for example, or labor shifts or unavailability, or anything can go wrong. So that's where a risk management plan comes in. And it's really about trying to identify what you think can go wrong, the probability of it going wrong, the severity, i.e., what's the impact to your project if it does go wrong.
Mhm.
And for the top ones, the ones that are, high severity and likely to happen, in fact, if it's going to be severe when it hits you, and it's very likely that it's going to happen, you put a plan. It's part of your base plan, right? But if it's, you know, moderate probability and, you know, moderate severity, you might say, I'll put a contingency plan. So if this happens, this is what I'll do. You know, and maybe the smaller stuff like low probability, low impact, you just say, you know, just put that in the general contingency bucket. But not only do you sleep better at night, but you also have a, you know, a fairly clear, you know, rather than just having a broad contingency bucket, you have plans with backup plans that allow you to get to the finish line. And, you know, I learned that as a, you know, I used to run development teams, right, in software industry, as well, product and technology industry. And so that's always what I did. I had plans, but then I had plan B, plan C, plan D.
Redundancies, you know,
Yeah. My stuff almost always delivered on time, right? Because I had those contingency plans.
Right.
But it's the same around real estate. So you got to have that. The third element would be your capital plan. So looking at it beyond just this one project, what we do is we're taking a look at all the assets we have. We figure out where we have opportunity because we're self-capitalized. So I don't take external investors, but it scales to people who are taking external investors.
Sorry, I want to spell that point out. So you're investing between your own cash and different debt instruments that are generally cheaper debt than what we're talking about. These folks out there are doing with private debt.
Correct. So I do use debt vehicles, right? Mostly from institutional lenders, but I don't take equity partners in. So that's what I mean by self-capitalized is, yes, of course, I do take lending products, but but I don't take equity investors. But equity investors, you know, can be part of your capital plan. So, you know, if I take a look at it in the simple ecosystem where I don't take in equity investors, I have assets and I need to be able to extract capital from them over time. And then that capital is not just used for acquisitions, but it's also used for contingency. So let's take the scenario that we were talking about here, is that, you know, a lot of people make the assumption that the value of the property is always going to go up.
Nope. We've had that many lessons happen many times.
And the other assumption that they make is that interest rates are going to stay within their normal range.
Yeah, we've had emergency rates for how long?
Yeah, exactly right. So
it felt normal to them, but they'd understand like they were these massive cuts were done for emergency reasons, like at different periods of time.
Yeah, absolutely. So let's talk about that capital plan for a second. So we'll talk about it in a really simple context. I take on a mortgage, fixed rate, you know, and this is particularly true in the commercial side. So if you take on a commercial loan and you start off and you've got a 5-year term on that loan, what happens after 5 years, right? You go back now to the lender, right? Possibly the same lender, maybe a different lender, but even if it is the same lender, and you say, I want to do another 5-year term, well, they're going to underwrite your property again from scratch as if it was a brand new loan. Okay? They're not going back and saying, oh, yeah, we'll just extend the term. Don't worry about it. Because they're auditing.
Unlike residential, where usually they usually don't do anything.
Correct, right? So in residential, they get a bit of a pass, but you still need to think about it because situations can change, bank policies can change, lots of things can change. So when I take on that initial debt, I'm thinking about how I'm going to deleverage it by the time I get to the end of that term. And let's use 5 years. So I'll be thinking about, okay, well, can I increase the NOI, the net operating income, so that I can increase the overall asset value. So that way, if I need to, let's say interest rates go up, right? Then if interest rates go up, then the debt coverage ratio gets hit by that, right? Which means that your total loan to value of your debt, it gets pushed down. And we've seen that, for example, you know, back 2-3 years ago, people were getting maybe as high as 85% loan to value with CMHC backing. Right now, if you were to underwrite those same properties, you might only be getting about 55 to 65% loan to value. So if the property hasn't changed in value very much at the end of that 5-year term, the bank is going to say, yeah, we'll extend the loan to you, but you're going to have to put some money into this. You're going to have to put some equity in. So if you don't have any of that extra cash, you've now got a really bad situation, right? Where you owe the bank money back on that first loan because they're not going to extend the same level of credit. So that's why I always make sure that at the beginning, I have a plan to figure out how I'm going to exit. So either I'm going to, increase my principal repayments, which is always the worst case from my perspective, right? I don't like doing that. Or I increase the value of the property. But any way that I look at it, I'm trying to figure out how do I deleverage that property at the end of the 5-year term. If I don't have a credible way of deleveraging at year 5, then maybe I'll take a 7-year term or even a 10-year term. I've done some on 10s on a highly stabilized assets because guarantee is a relative word, but highly likely buy this, it's guaranteed. But over at the end of 10 years, the likelihood of my ability to deleverage that asset is actually really very good in one shape or another. So that's, at a simple level apart from a capital plan. Sometimes you can't, but you do need to take a look at it at your portfolio wide, and you have to have this continuous thing of when am I doing refinances? When are my loans coming due? How much equity do I have here? What if interest rates go up and I have to, drop a bunch of equity into these, maturing loans? Where am I going to get that money from? So when something happens, if I get 2 years down the road, and let's say interest rates are as high as they are right now, right? In fact, as high as they were 6 months ago, right, to be at the real peak, then, at that situation, I've got two choices. If I've built up the equity, right, then at least I'm protected as I do a renewal because now the increased NOI, the increased asset value means that I have the debt coverage ratio to maintain at least the old loan and maybe squeeze out a little bit more. But if the interest rates come down, well, now I'm in a situation where I can, go in and do a refinance and take some equity out and generate new working capital for new projects, new acquisitions, all that kind of stuff. So there's no downside to having a capital plan, right? It just keeps things predictable.
Right. Which makes me wonder about the capital plan of some of these other investment groups. Because again, we have, we have court documents stating that that this one group had over 200 units sitting vacant.
Yeah.
Like, and then I've said on the show many times, like my ex-wife was married. They're in the trades, so I've had firsthand experience. I've done many renovation projects myself, and just seeing how there is generally a shortage of labor, good quality people to do your renovations. My model has always been one or two properties that are vacant at a time at the most. And
Hmm.
I'm in a pretty big market. I'm in Hamilton, right? Population of Hamilton's over 500 million. Sorry. 500,000. Hamilton proper has a population of 500,000. I have a significant pool of resources to draw from.
Yeah.
Here we're talking about like small towns. Like,
Yeah.
how can you possibly staff? Some of these were basement suite conversions, which is a major renovation. How do
Mhm.
you staff that team in a small town,
Well,
right?
that's right. Now, a lot of those vacancies, if they're legitimately being done as part of a repositioning project, et cetera, is actually going to go on your balance sheet anyway, meaning that it's not coming from your cash flow and you have to take all that vacancy and that loss basically has to get refinanced out at the end. And that has to be part of the plan. Whether they did that in this case or not, who's to say? I don't have that level of privilege in their information,
Mm-hmm. Mm-hmm.
but that's where it needs to be. But if you're just running it generally and you just have vacancy rates because you're not managing it, right? That's a direct impact to cash flow and your ability to sustain the debt that you have
Mm-hmm.
associated with these properties.
Mm-hmm. Mm-hmm. Yeah, for most, just to have one unit vacant is quite a pain. So let me back up. Like, for example, someone like there's lots of condo investors out there. For example, if any one of them, these condos are like $800,000, and it's only one rent. Like, for if that tenant's not paying rent for
Yeah.
months on months, like that's quite devastating to most.
Yeah, it
Here we're
is.
talking about 200 units.
Now, if it's
in a
200, to be fair, if it's 200 units out of,
600
2,000
something. Yeah.
or,
It's, it's it's a 30% vacancy. And so,
30% vacancy is hard for anybody to absorb, right? And
yeah.
that doesn't again, if those 200 units are part of a full repositioning project, right? Fair enough, right? But if it's not, then a 30% or 33% vacancy is pretty brutal.
But just think how long it would get through repositioning 200 units.
Especially if a lot of them are in the same town, there's only so many trades. Or are you going to bring
Exactly.
trades in from other towns?
Exactly.
Yeah.
My overall point is it's okay for folks to go slow and steady,
Yeah.
slow and steady, you know.
Yeah. No, exactly. And just have plans, right? Like this isn't a off, there's a lot of money involved. So
Tons. Talking about
it's
100 over 140 million in mortgages.
well for them, but even for the individual investor, right? You're talking about a lot of money. It's not inconsequential.
Hmm.
And you don't want to be shooting from the hip. You really want to think through what you're doing and how you're going to make the money. Like you know me, when I buy something, my plan is deterministic. I'm not just guessing or speculating and thinking that, my property is going to go up. I know precisely how I'm going to make my money. Now, there's going to be some variances on that because you can't predict everything in
Hmm.
life, but
No one
but
predicted COVID. No.
exactly. So, but it's very predictable. It's a business case for me. I know precisely what outcome I'm expecting, and
Hmm.
I manage to it.
Hmm.
So you don't want to be shooting from the hip on this stuff at all. And I see a lot of people too that are in the camp of, well, I'm going to buy this and it's going to be negative cash flow, right?
Hmm.
But that's okay. I'm going to make my money up later. Well,
Hmm.
how? So negative cash flow can work, but you have to have a well-defined business case that's going to tell you exactly how you're going to exit. And that on that exit, it's going to generate enough cash flow, either through
Hmm.
a sale or refinance,
Hmm.
to more than offset all the losses you were taking previously. But here's the one thing that I know as operating a business and an investment business is that in the large scale of things, negative cash flow keeps you from scaling. It really does.
Hmm.
So can an individual project be negative cash flow? Absolutely, because it's tied to a business case. If your portfolio, right, and if you're owning 3, 4 properties and they're all negative cash flow,
Hmm.
you can't sustain that for very long. Your income job can only cover so much, right? So, but I still see people do it.
I'd also like to make a general statement that a lot of people who are getting into heavy financial trouble these days, they're following models, investment models, business models of high leverage. Like for example, again, like the one case that we're talking about, it's 100% loan to value
Mhm.
for first mortgages, second mortgages, and promissory notes. So from the outside looking in, it doesn't look like the principals have any skin in the game.
Correct. And if it's an individual project in a broader portfolio that's otherwise, at a good debt to asset ratio,
Yeah, yeah, yeah. Well, yeah,
then fine, right? Like as long as you have a business case to back it up and you've a track record to execute. But if your entire portfolio is at 100% leverage, right, that's a house of cards.
yeah,
It- you're just not going to survive it.
yeah. So I don't know what kind of disclosures were if they were all properly made, but this was never something I would get into. But the point I was trying to get to is that if anyone is taking a course or coached by someone that preaches such massive over leverage,
Yeah.
you may want to consider something else,
Yeah,
right?
I completely agree. It leaves people so vulnerable at the end
Yeah.
of the day. Can you do no money down deals? Sure, you can, right? Like there's ways to do it. But in most cases, and what people are teaching people on those is to put you in such a high leveraged position that if the economy burps, right, you could be completely
Hmm.
destroyed,
Yeah.
right?
You
And
have
and
no wiggle room.
no, there's no wiggle room at all.
And even
And
worse, if you quit your job to try to become a full time investor,
yeah,
gives you
yeah,
even less wiggle room. You've given up six-figure income.
yeah. It's not pretty, and it's not necessary. There are other ways to do this stuff. And when you're first starting out, your first couple of doors, I know that's a bit tougher, right? And you do need to take some risks, etc. But again, risk doesn't mean no plan, right? risk means something that you can quantify and put a plan around so that you have a way to get through it. But if you're just speculating, right, at 100% leverage, right, it's just, it really won't end well in most cases. But we should probably talk about the lender side a little bit.
Sure.
Yeah. And so the lender side, you and I have talked about this many times, is really a lot of people don't necessarily know how to do underwriting properly as a lender.
With all these bankruptcies going on, I disagree. For gaining any new listeners, understand I can be extremely sarcastic. But yes, something was wrong here.
Took me a second there. I mean, you did it with such a straight face, Erwin. So
for this amount of leverage in small towns with such a complicated business model, right? Something doesn't smell right.
Well, underwriting is a complex process, right? And you were telling me once that actually just before this call, people saying, well, I've loaned money out at 18%, and I've been doing this for several years, and this would come through, and I'm devastated, right, that this happened. Well, not if you underwrite these things properly. You expect some losses in your portfolio. So the way to think about it is the first part of an underwriting is really what you're alluding to, which is due diligence, right? Making sure that who you're going to loan money out to is credible, that the project is credible, that there's a clear exit plan, that you know exactly how the money's coming back to you. I won't loan money to people who will, I don't believe have a solid plan to get the money back to me. So as a lender, I want that money to come back. Now, that doesn't say I don't loan to high-risk individuals. I do, right? But in those situations, I'm looking at the quality of the borrower, and I'm thinking, okay, well, if I were to have, 10 of these guys or 100 of these guys, what would be the probability of default? Okay, and I'm expecting that out of 100, maybe 10 of them will default, or 20 of them might default. So I'm prepared, and expecting that some of these loans might not do well, right? And that I might have to invoke a foreclosure, or in the case of prom notes, and yeah, I have done prom notes, right? Written prom notes, but I can assure you that I'm underwriting it with the expectation that sometimes there may be a loss. Therefore, the compensation that I get back, be it in the form of a lender fee, be it in the form of an interest rate, whatever it is taken into account that a certain portion of those loans are going to default. Now, it's never pretty if it's your first one.
Or if you put all your eggs in one basket, but yeah.
Yeah, right. But a certain portion of them are not going to come back. And that's just a reality of life, no matter what your diligence is. So you have to set your compensation, be it an interest rate or be it a lender fee, whatever it is in combination, that is going to ensure that over the long run, you're going to get a certain rate of return. And you should have an expectation of what your blended rate of return is going to be. And you should expect that sometimes these loans aren't going to make it, and therefore the ones that do make it are going to help cover the losses that you had on the other side. And that's part of, it's a bit of an actuarial science. So if you're really good at math, it's helpful.
That's another subject we have to talk about.
But the expectation should be there, right? It
can be done as part of a diversified portfolio.
Yeah.
If no one doesn't believe me, just look at Visa's stock. They've done lots of unsecured debt and made a really good business out of it.
That's right. They don't lose money, but take a look at their interest rates. Their interest rates are running at 20, 21, 22, 23, whatever percent.
I think mine's 29, but yeah.
It depends on the card, right? And the quality of the borrower, maybe.
Yeah, no, they don't like me. They keep trying to throw more debt at me all the time. It's so annoying.
Yeah, absolutely. They want you to spend more and hopefully not make a monthly payment so they can charge you interest and fees.
Yeah, exactly. Like, this is some people's business models. But I'm not. But so actually, that's a good point. Is Visa's collecting over, and they're very, very good at collecting. They're over 20% interest, and it's not just that too, because they charge back, and then every new money also they charge on as well. versus the promissory note money that we're seeing in the market is like 17%,
Mhm.
right? Like and part of the problem with me ever doing private lending, especially promissory note, is I might be more interested if I'm getting credit card interest rates because
Yeah.
I don't feel right about giving someone unsecured money so they can go pay down their Visa MasterCard.
What's the exit plan?
That too. Yeah.
It's
And
like,
that's the part of the point as well. So even just like on the personal level, like a lot of people are getting promissory notes from like friends and family. Like
mhm,
I it's not like I have a policy, I don't lend to family,
mhm.
right? Or friends, right? So people need to appreciate that. So say someone you've lent promissory note money to, and they've gone quiet. Mortgage the notes matured. They've gone quiet. They're not paying you back. Like
Yeah.
these things ruin relationships.
It really can, and it's a good point. I'm always hesitant to do it, but I will do it, and for very specific criteria, right? So, especially with lenders, but you don't want to get in a situation as why did you loan money to Billy, but you didn't, you're not loaning money to me.
That's even worse.
Oh yeah, yeah. Don't
And
want
then
those.
you have to call lawyers on both of them.
Yeah. Yeah, but I might loan money to Billy because Billy needs a second mortgage to complete a project that I know, conclusively is going to complete, and he has a track record, and I can easily explain it to the rest of my family that
Yeah.
that it's there. Now, I have the advantage that my family is not very big.
But your network is big.
Yeah, yeah, that's true. And so, certainly with friends, I've never loaned to friends. And I think it's probably because, like you, I have a bias against doing it. I don't want to destroy a friendship over money.
Because
But
it'll happen.
it will happen.
Because like for
Um,
example, the 300 lenders on these projects will likely hate the principals involved.
yeah,
So people need to understand that as well. If you're gonna take people's money, whatever vehicle it is, and you lose it, understand that will change the relationship going forward.
it sure will. Absolutely. And
If you
just
make the
to,
money, they will like you. They will like you lots, right?
no,
You
I
lose their
was gonna,
money,
mhm.
right? You lose the money, you're not getting Christmas cards ever again.
Some people don't care, right? And we've seen some actors out there that I just question whether they have any ethics at all. They seem to have no concern about borrowing money from people, taking money from people, without any plan of being able to return it,
Right.
right? And they're not even bothered by the fact
Mhm.
that they couldn't return the money, right?
Yeah.
And you know who these people are,
Yeah.
right?
And the sad part is there's lots of them out there
Yeah,
promoting stuff with
yeah,
ads, whatever.
they're really,
I've talked offline about, we think other people are going to be train wrecks as well. And
Mhm.
again, I feel sorry for the people that will be involved, but we're not the OSC. Like we have no
No,
means to, we don't have the resources to judge. And again, like we have our own lives and our own businesses to run. So
yeah.
people need to really do their own due diligence. Actually, I
Right.
need to add a piece about that as well. You
Okay.
mentioned about like the credibility of someone.
Hmm.
So for example, one of my standards is, again, just because I've been around a long time, my standard is that someone has been through a full cycle before,
Hmm.
and a lot of these people who are going under have not. So
Hmm.
I question why these people were trusted, right? And I mean full cycle. I mean, like you had to, like 2007 was really light. It
Yeah.
was not that bad, right, in terms of a correction. But again, credit disappeared, so that was painful for many, especially anyone who was like flipping or trying to. They couldn't refi, right? So again, I knew that from then. Like credit can disappear. If credit disappears at any point in time, we are so screwed. No different than like all these people who have business models reliant on CMHCs, anything for their exit, for the refinance, whatever. So you're,
Mm.
you know, I think everyone should like you're relying on government for your exit, right? All right, right there is a slight challenge. But again,
Yeah.
my point is though is that uh, I would never invest with someone who hasn't been through a full cycle. So I cannot believe the amount of money that these folks were given. Like any folks out there.
Well, I think part of it is that, if we try and become armchair psychologists around this,
Yeah.
is that we get people who are caught up in the real estate frenzy. They feel that, they're told over and over again that you can't lose money in real estate.
Oh, I
Uh,
could show you a million
When you
ways.
loan money, it's secured against an asset. You know, a lot of people don't understand that second mortgages are not risk-free. Even first mortgages are not completely risk-free, depending on the loan to value.
Mhm.
And then, there's all this, and I think there's a lot of FOMO, right? So, because of all this, people feel that if I'm not getting involved in this stuff, then I'm not making the best returns that I possibly could,
Mhm.
which of course is a false narrative. And then there's a lot of people there that have, either, I would call it manufactured credibility, right? But they're out there.
We were talking
I
about
was
it
going to
before.
say that they have some credibility or manufactured credibility, but no, in all the cases, I think if you have credibility, people will listen to you and you'll be giving them sage advice.
Mhm.
So I'd say manufactured credibility where they say, well, if this person thinks it's okay, right, then it must be okay,
Mhm.
right? And if not to pick on anyone specifically, right, but if a broker that you think you trust, right, is saying this is a safe investment, right, and you just blindly give your money because you trust that broker, but it turns out it's not in fact a safe investment, the
Mhm.
accountability has to come back to the lender in that case. You need to take account of exactly, if maybe the broker told you that it's all good, and maybe they're right. And,
Mhm.
and a lot of brokers are really very good people, but it could very well be a situation where you need to do your own diligence because at the end of the day, the lender is the one holding the bag. So you have to do your due diligence and make sure of all the things that we talked about before.
You should be able to justify to your spouse how you made this decision.
I like
This is the
that.
bag I'm holding, and if it's a great bag, because again, like private lending can be done properly. Like
Yeah.
if the principal the borrower defaults and you get a great property at a great discount that you would want to own any day of the week, that's probably good,
Yeah.
right? And also we talked about like the broker's responsibility. You and I were discussing how we have one of their documents where they were promoting one of these mortgages, and the verbiage the copy of the language is, quote, we thoroughly endorse and approve these borrowers.
Yeah. Yeah.
And this is on one of the mortgages properties that
That
is in
lends a lot of
issue.
weight to relatively naive lenders,
Yes.
right? It's not good,
Yeah.
right? And I want to emphasize again for people that thinking to lend their money, don't rely on that. Do
Yeah.
your own due diligence.
Do
You
your
have
own due
to
diligence.
figure it out.
Like when I was working with clients directly, there would be a property manager.
Yeah.
He'll tell you what this can rent for, right?
Yeah.
Here's a home inspector. He'll tell you what he thinks about the property. They're all third party. You are their client. They're here
Mhm.
to protect your butt,
Mhm.
right? Do your own due diligence. See the property yourself. Such a foreign concept.
Yeah, and I think we also need to make sure people understand too that like good quality borrowers, right, are not much of a headache. You just kind of deal with them, at the beginning, you deal with them towards the end, maybe a couple times in the middle. They're not a
Mhm.
lot of overhead.
Mhm.
A bad quality borrower, even if you don't go into a power sale or foreclosure, are a lot of work, right? And I've had bad quality borrowers. I did it on purpose, so my eyes were wide open, and trust me, they're making, I'm making money on it. But it sometimes can be a distraction, right? It can be a lot of work where you're
Mhm.
trying to manage
Mhm.
uh, manage the situation with the borrower so that they don't become insolvent, for
Mhm.
example.
Mhm.
Or if you're dealing with, one of the, RSP trust companies, for example, like Olympia, for example.
Yeah, I'm sure they're gonna be pissed about all this too. They don't
Well,
make enough money for all this trouble.
Olympia has a lot of overheads and so on, right? And we also have to recognize that they are acting as a trustee and they have an accountability not just to you, but also the federal government as
Mhm.
managing things as a trustee. And they're going to put you in situations where you're forced to do something that you might not think is necessarily in your own best interest, but them's the rules.
Mhm.
So you have to take that into account in what you're doing.
Yes. I think we'll leave it there, Christian. Thanks so much for your time. I know you got to run.
Mhm.
Any final thoughts?
Well, I think we really
Or an
covered the,
Oreo?
well, sure. Yeah.
You screen for you screen for quality of people that come on stage and stuff like that?
Oh, and we absolutely do, right? You're never going to be sold at, right? If you come to an Oreo event, right? We curate those events very carefully to make sure that it's information for people. And you don't have to worry that someone is going to try and sell you from the stage. There's nobody telling you to run to the back of the room, nothing like that. So, and as you've been a presenter a number of times, you and Cherry.
I've been screened, I know.
Yeah, you've been screened, exactly, right? And I've always said, you don't sell from the stage, right? So we want to make sure it's a safe environment for our club members, and I'll shamelessly promote the club, right?
Please, I'm a member, proud member.
Yeah, it's the Ottawa Real Estate Investors Organization, OREIO.org. The membership is only $127 a year. It's been
which
like
I suggested you increase.
Yeah.
At least the Ontario rental guideline rental increase allowance.
I think that would be I think that's a clever idea. We might try to do that, 2.5% this year, just for just a bit of tongue in cheek. But it's we're a not-for-profit club, right? One of the very few that you'll ever find around, and we're a very large club. We have nearly 400 members. So
you're very good.
You're in very good company and in a safe space to to network with people in real estate.
And I'll just also add that thankfully that the principals such as Robbie Clark, who had never heard of before, and Dylan, who I've never met personally, have obviously never been on my show as well. But yeah, and sadly, many other shows can't say the same. All right, so we'll leave it there. Christian, thanks so much for doing this. And we'll talk about Oreo another time.
It's always fun, Erwin. And, I think people should really take a lot of stock in what's been discussed today, because that's why we wanted to have this discussion, was to make sure that, we help to keep people safe in these environments.
Yeah, stay safe out there. Go slow. Go. Don't rush into it. And Christian, are you still offering coaching? Because one thing I want to say is, like, for example, I mentioned about like if a course is saying like go highly leveraged, yada. Like, these courses are a lot of money. Like, why not at least buy an hour of consultation with like someone like yourself, or like Elizabeth Kelly, or like a Ryan Carr, all these people who are unbiased, been there, done that. So like, can I get a second set of eyes on this?
Well, I think that's really important. And as you know, I take on very limited number of clients. My principal business is my investment business. And so I tend to only take on people that are, already well along in their investing career. And it's very much like what you said. It's a second set of eyes, or it's refining their processes in order to create scale or operational efficiency, et cetera. And I often getting people asking for a second opinion on their deals. In the coaching side of things, I would publicly endorse Elizabeth Kelly, right? Especially with beginners or people that are very early in their investment career. To your point, having someone like Elizabeth on board is someone who ultimately, like, people look at it and say, "Ooh, look at the ticket price of doing that." But if you have a real, true quality coach, right, a good quality person, that investment's going to come back very quickly. Just in terms of protecting you from the downsides, looking for opportunities, and accelerating, your success. So coaches and education programs that are out there, there are lots of good ones, right? Unfortunately, there's a lot of bad ones. Right?
A lot of bad ones.
Yeah, but that's why I like Elizabeth. I know extremely well, and I have no problem publicly endorsing her.
All right, we'll leave it there. I know you gotta run. I gotta run too. Thanks so much for doing this, Christian.
My pleasure. Take care.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link is also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.